Assalamualaikum warahmatullahi wabarakatuh. Good morning, ladies and gentlemen. Today, we are going to discuss about the role of Bank Indonesia and the government in managing the equilibrium of the financial system in Indonesia. Subprime mortgage in 2008-2009. A crisis that hit almost all economies in the world, and started in the United States of America, was caused by the monetary relaxation of the FEBI, which triggered a large number of mortgage loans. In 2007, the Fed lowered interest rates, which resulted in a real estate bubble that started entirely at low interest rates because many people who did not own a home in America were interested in buying because of the low interest rates by taking mortgage until house price rose. However, the policy of the bank that provides mortgage is not carried out properly by giving mortgage to people who are less worthy. As a result, many defaults occurred, causing global financial chaos that had an effect on the world. Firstly, the instability of a country's financial system can have an impact on the country's economic growth, people welfare, foreign companies' loss of trust in expanding their business in that country. The intermediary function or financial intermediary of a country's financial system cannot be achieved properly, and the stability of a country's monetary system cannot be achieved either. Therefore, stability in the financial system has a favorable economic impact on growth. The balance of the financial system is the fairly consistent condition or situation of a country's financial system so that it can perform the function of an intermediary or intermediary and can withstand shock in terms of the financial system. Based on Law Number 23, Bank Indonesia has the jurisdiction, obligation, and key role in ensuring the stability of the Indonesian monetary and financial system. Monetary system stability and financial system stability are two things that are interrelated and cannot be spared as the three main principles of Bank Indonesia. Secondly, the Finance Department is responsible for securing the state's stable financial system through policies and instruments. First, Bank Indonesia has the natural authority to supervise banking performance and activities to create sound banking. Second, maintain security and smoothness in the payment system so that there is no risk of systemic disturbance by implementing the RTGS. Third, the inflation targeting framework is a monetary policy with an instrument and application regarding interest rates. Fourth, Bank Indonesia serves as a leader of last resort, namely the guarantor of the financial system, provides liquidity to banks in crisis to reduce or ease the burden of systemic risks. 5. Bank Indonesia has the authority to obtain information that disrupt financial system stability by using macroprudential indicator. Thirdly, the strategy of Bank Indonesia in maintaining financial system stability is to implement various policies and instruments. First, Bank Indonesia followed the step of the World Bank in preventing a financial crisis that had an impact on the country's economy, such as the Bank for International Settlement Policy. Second, regulate the institutions related to the crisis to be responsible and carry them out according to procedures also called crisis management. Third, establish cooperation or coordination between government institutions in order to create stability in the state financial system based on Article 10, Paragraph 1 of Law 24 of 2004. Several national and international parties to maintain financial system stability. In internal coordination, in 2016, the Financial Sector Stabilization Council was established. The Central Bank, the Financial Sector Department, and the Deposit Protection Corporation are all part of the Ministry of Finance, which was formed to oversee the state financial system. The Financial Sector Committee and the Basic Committee on Banking Supervision is a form of coordination carried out by the Bank Indonesia, which was founded on ensuring system integrity. Bank Indonesia's first strategy is to conduct monitoring to measure risks that can lead to financial system instability by implementing two policies. namely macroprudential policies and macroeconomic policies. Fourthly, macroeconomic policy is a policy that focuses on the price of goods and services by balancing supply and demand. And those responsible for this policy are Central Bank Indonesia, the National Treasury, and central and regional government. Meanwhile, the macroprudential policy is a policy that is centered only with the head of specific financial institution, and the person in charge of this policy is the Financial Sector Authority, or OJK. Macroprudential and macroeconomic policy are the main policy or indicator of Bank Indonesia in implementing monitoring. However, in its implementation, macroprudential policy instruments play a major part in protecting financial stability. Macroprudential policy is a policy that focuses on financial system stability to reduce systemic risks. The authority and responsibility for macroprudential policy lies with the Financial System Stability Committee. FEBI, based on Prudential Regulation Number 82 of 2016, concerning financial inclusion strategies, it is necessary to have comprehensive or equitable public financial inclusion to improve the economy and financial system stability. Financial inclusion can be interpreted as public access in accessing financial product and financial service. For example, banking product, insurance, investment, and other. According to data from the OJK, Indonesia financial inclusion in 2019 is 76% of Indonesians who already have access for finance, and the financial literacy index has only reached 38% of the people who understand how to operate financial products such as transfers using banking. The parties involved in increasing the inclusion index and financial literacy are OJK, the central government, local government, the private sector, academic, and Bank Indonesia. In conclusion, the financial crisis can affect the stability of a country or a global economy, which can strike at any time regardless of time and requires a long time in the process of recovering a country's economy. Such as the supermarket crisis that had originated in the United States in 2008-2009, which resulted in economic shocks throughout the world, and several other crises caused something to do with a country's financial system turmoil. Therefore, the role of the government and financial institution is important to avoiding the threat of financial crisis by ensuring financial system stability. Thank you very much for your good attention, ladies and gentlemen.